The closing entries being the last step in the accounting cycle. So we're going to go over what that means and how we do it. So first of all, here's the one we're working on, closing entries review. So you see you get a trial balance here with all the accounts listed. Remember that on a trial balance you have we have all the accounts, but you have two separate statements that are here. So there's your drawings, everything up, right? Okay, I'm going to erase that because that was garbage. But you've got your balance sheet, and then everything below drawings is your income statement. Okay, so what do we do when it comes to closing entries? Closing entries means that we need to have all the accounts ready for the next accounting period. So whether it's a monthly thing or if it's a quarterly or yearly or whatever, you have to empty or zero out the accounts that we're going to use. Again, have to start at zero. We have to update the balances on other accounts. Okay, so to continue after a couple phone calls and other things. Anyway, I'm not sure where I was. So yeah, the idea is to zero out the accounts that are not permanent accounts. So we're talking about, hold on a second here. So we're talking about accounts like the expense accounts. We're talking about the revenue accounts. Those are going to get closed off. And we're going to put those. So basically, you're basically figuring out, how much did you add or how much did you subtract during the course of business. And then you're going to take that and you're going to add it into the capital account. Drawings is also going to be affected, but let's see what that looks like. So basically, most of the work is done with the what do you call that thing? The income statement accounts. So how do we do it? So first of all, we put this is our journal entries of our closing entries. So December 31st, we're going to close out. So you can do these individually. So individually it look like this. You have fees earned. That is what that says, even if you don't think it does. And there's your account number, 16,000. Okay, and we have now there's two ways to do this. We're going to do this the long way first. And we have an account called income summary. Okay, and you're going to do the opposite of the account. So a revenue account, right, it increases, it's a credit increasing account. So you're going to put a debit transaction to empty that account. So basically it's like emptying bank accounts or zeroing out accounts. So you put the opposite of its regular increase to reduce it to zero. So there was 16,000 in that account, so now there's nothing, and it goes into an account called income summary. Okay, and then your note would be to close fees earned. Right. Okay, and then same 31st, and then we've got the next one is called ticket sales. And ticket sales is 410. 410, try that again. There is 5,000 in that account, so we've got a $5,000 debit. Income summary is the other account, 5,000, and it's to close ticket sales. Okay, so that's the long way to do it, where you do it each individually, which is totally fine, especially to start that way. While you get used to it, I'm going to erase this. Oops, didn't mean to erase that. I'm going to erase this to show how you can combine entries. So fees earned and ticket sales closed at the same time. Okay, so that is, what was that, 410, and that's 5,000. So that would make the opposite, the income summary account would be credited, a total that would be 21,000, and then that would be to close revenue accounts. Okay, so the next part is, so still in the 31st, I'm going to do this the bulk way this time. So this case, we always start with the income, or sorry, the debit transaction. So this kind of income summary account is going to be first. And income summary, when you add up all of them, we'll get to that in a second, but I'm going to go through all the expense accounts. So you have add expense, and you have delivery expense, and you have insurance expense, and you have miscellaneous expense. Really like that word, miscellaneous. Then you have salaries expense, and you have utilities expense. Okay, so the add expense is 505, that's 510, 515, 520, 525, and 530. Okay, and then the amount in here, they're all debit because, again, remember that an expense account increases on the debit side, so we're going to do a credit. What I meant to say, credit transactions to zero them out or to empty those accounts or close them. Okay, so here are the totals that were found on the trial balance. And if we add those all together, the income summary debit would equal 15,300. Okay, so we've got a debit transaction income summary of 15,300 and a credit of $21,000. Now, the next step then, so still on the 31st, is take income summary, and you're going to take the difference between those two numbers, right? So your difference between 21,000 and 15,300, which is 5,700. Okay, so 5,700, right? That's two things. Yep, that's right. Okay, so 5,700 is the difference between the two. So what you're going to have is, so income summary should have a credit balance, right? Of well, let's see. Yes, it should have a higher credit than it does a what am I trying to say here? Different credit. Credit is higher than the debit. Is that what I'm saying? I feel like I'm saying, but I don't. Yeah, okay. Am I saying that? Yeah, right. So, okay, so you're going to have a balance of 5,700. Boy, I don't know what I'm talking about here. So that means you're going to have, yes, you're going to have to do a debit transaction on your income summary, right? And you're going to have it for, I just had it there, 5,700. There we go. Okay, and then we're going to put it into, what's that guy's name? M. Clark Capital. That is not how you spell capital. What are you doing? Drop my pen. Capital, there we go. And the capital account is 305. Okay, so that means it's a revenue, so that is to close income summary. Okay, so 5,700. So basically you are adding 5,700 to the capital account. Now the very last thing you have to do is you have to do the drawings. So drawings are, so we got capital. So it's going to be a debit because a drawing is a reduction, remember? So when you go to balance that off, you're going to have obviously a reduction of the capital, because that's what happens when you take money out of the business. Okay, and it's 310. So we have $1,000 in drawings, so that's to close drawings. That does not look like drawings account. Perfect. So there, that is all there is to it. There is another way to do it. You can do it where you completely skip the income summary account. Once you get more used to it, you can do that. So you'd have fees earned, ticket sales, and then the other side you'd have, this would just be straight into capital. So you'd put 21,000 into capital. This would be capital here, and then you'd empty those all out, and it'd be 15.3. The difference would still be the same. You'd still end up with a credit of 5,700 because you made that much money over that period of time. Then you still have to have, the last one still has to be drawings. This one, drawings, goes last all the time. Okay, so you always have to settle out the capital account before you do the drawings. That's the last one. So again, right, the accounts that are affected or will end up with a zero balance are those ones. And this one will be either increased or decreased. All of these are permanent accounts. They are not affected, okay, because they're going to be used in the next cycle, and your bank, or that would be your cash or whatever, that's not going to change. It's going to start wherever it's going to be a forwarded entry or a forwarded balance. It's not actually going to change. All right, so I think that sums that up. Hopefully that was remotely clear. All right.